Hello everyone, my name is Philip Palumbo and I'm going to be your host for today's event on how to invest like the best and most importantly, the key fundamentals to make sure that you're successfully investing. I'm going to start with the three most common mistakes that I notice investors make from the 22 years of my experience in working with individuals and families and managing their money. The first common mistake that people make is they're always chasing returns when things are good. And when markets go down, they sell wrong and they get completely crushed. The second mistake is they're too short-term minded. They have no investment discipline. And the third is they have no idea what to do with their money. They're like a deer in the headlights. So to give you an idea on the first example, this is over a 5-year period. This is a technology exchange traded fund ran by Kathy Woods at ARK. And during this 5-year period, you actually made no money. But there was a period where ARK performed really well and many investors purchased this investment at the top. And then when it got crushed, unfortunately, investors got crushed as well and sold at the wrong time. When you look at this chart here since 1973, if you invested $1, you made 166 times your money if you sold in 2021. But the problem is during these periods of time, markets are down 20%, 12%, 15%, 50%, 40%, even as great as 60%. So during these volatile times, what happens is investors are too short-term minded and they start trying to time the market, figure out where the economy is going, and they make tremendous mistakes. The third mistake is not knowing where to invest your money. As you can see with this chart here, there's a plethora of products and various sayings in our industry and investments, and they're listening to the media where they're completely like a deer in the headlights and they just can't make that decision to invest their capital or their money that's invested, they're nervous about. When I was thinking about this webinar today and these three, what I call symptoms, they're symptoms of really the core two emotions. The core two emotion is, what are people really feeling? Investors are feeling this fear of missing out when markets are great. Take cryptocurrency, take the tech sector more recently, and the fear of losing everything when the market goes down. That's whether you're invested or whether you're looking to put money to work. So these two core emotions is everything as it relates to investing. So my goal today is very simple. I want to transform your investment mind so you are confident with the choices that you make as it relates to your investments. I'm going to give you the tools necessary so you can make those confident choices. And by far the most important thing is I want you to have a long-term discipline with your investment approach so you do not have to worry about the ups and the downs of the market. That is key to what I want to do for you. What you will learn today is you will learn how to buy at the appropriate time, how to properly balance and rebalance your portfolio, and to know, are you working with the right financial advisor? So who am I and why should you be even listening to me? Well, my name is Philip Palumbo and I'm CEO, founder, and chief investment officer of a large registered investment advisory firm called Palumbo Wealth Management. I worked for some of the largest Wall Street firms for about 20 years. I'm a consistent contributor on CNBC, Bloomberg, TD Ameritrade, Reuters. I've been written up in Barron's and Wall Street Journal, and I manage money for some of the most successful individuals and families on Long Island, in New York, and throughout the country. I could tell you that I'm not from money. I grew up in a blue-collar background. My dad was a local 3 electrician. My mom stayed home to care for my older brother and my younger sister. So everything that I built from scratch. And I can tell you from my 22-year career that I've made mistakes as it relates to investing money. And I learned from those mistakes and I've gotten better as a result of those mistakes. And I'm here to tell you what I know what doesn't work and what I know what absolutely works. So let me give you a case study of a specific client who started with me about 7 or 8 months ago. When this client came into my office, he shared with me that through his business, he came into money. The first thing he did is went to a major bank, one of the largest banks in the world, through their private client group. And he thought to himself, private client group, they rolled out the red carpet. He's going to have great performance, great experience. And what ended up happening, when I audited his investment strategy, is they purchased him stocks of companies at stupid valuations and he got completely crushed. And here I am cleaning up the mess. And now his portfolio is reinvested in quality, properly balanced, and he has a plan to understand what his vision is today and the future and what we need to do to make sure he accomplishes that. So now, day to day, when he gets in his car and he's running his businesses that he runs, and he thinks about his investment strategy, he knows that he's in good shape, that he no longer needs to worry, no matter what markets do. And that's been transformational for him. And that's what I'm about to teach you is going to do for you. So how do you do it? I am such a big believer that if you want to be the best at something, study the best. If you want to be a great basketball player, study Michael Jordan. If you want to be a great golfer, study Tiger Woods. If you want to be a great investor, in my view, you got to study Warren Buffett and Ray Dalio and model your investment strategy off of them. So the solution to the fear of missing out or the fear of losing everything is understanding value plus balance. So what Warren Buffett does to uncover value, and what he says that cash to a business is like oxygen to an individual. What Ray Dalio says is when you invest in non-correlated asset classes, it helps you to gain superior returns while reducing your risk on the downside. So these are two important principles when it comes to investing your money. So let's get right into it. The first question you probably have is, well, how do you actually uncover value? Cash flow. Cash flow is the number one thing that you need to know as an investor. And what is cash flow? Well, cash flow is defined as the cash left over after a company pays for its operating expenses and capital expenditures. Bottom line is you invest your money in a company, real estate, or public company. The cash you receive is going to be after all expenses. That's called cash flow yield. Now, what's really important about that is you want to know that that cash flow yield you're getting on your initial investment is got to be greater than the risk-free rate of return. The risk-free rate of return is very simple. It's the treasury bond, whether it's a 1-year treasury bill or a 10-year treasury bond, depending on what risk-free rate of return you want to use. If that's paying something, you're not taking any risk there. If you're going to invest in a company, real estate, or public company, you're taking on a lot of risk, so you got to get paid for that. So your cash flow yield has to be more than the risk-free rate of return. So let me give you an exact example. This year, if I said to you, let's invest in a real estate property, it's going to cost you $1 million. Your next question to me is going to be, that sounds great, Phil. What's going to be my overall return on my money? And if I told you 2%, you would say, well, Phil, why would I invest in 2% when I can invest in a 1-year treasury at 4%? My answer to you would be, you're 1,000% correct. So you would not invest in this real estate property simply because when you invest in a real estate property, there's risk. Tenant may not pay. There could be a fire in a home. The roof may go, which may cost you money. So a lot of things can go wrong, much like when you buy into a stock of a great business or you buy into a private business. So because of that, you need to get paid for that risk. So if this real estate property is paying 2% and the risk-free rate of return is paying 4%, you need to be getting 8, 9, 10% or greater on this real estate property for it to make sense for you from an entry standpoint. So that's real estate. Let me give you a stock example. The first thing you need to know about investing in stocks of great businesses is that you own a slice of the business. So stop looking at it like your stock price every single day. You made money, you lost money, what market's doing, it doesn't really matter because you own that business and your goal is to own that business for a very long period of time. So Warren Buffett, when he made his investment in Apple in March of 2016, he made $130 billion for his investors. So how did he do that? How did he know to buy Apple at the time that he bought Apple? Well, at that time, the free cash flow yield was 11.75%. So in other words, the way he looks at buying into a business is, if he looks at it like, if I bought the entire business of Apple as the owner, he was receiving 11.75% in cash flow. At that time, the 10-year treasury was at 1.985%. So he was getting 6 times what the risk-free rate of return was. That's a good investment. And that's why Buffett made over $100 billion for his shareholders. What else do you need to know as it relates to investing in stocks or great businesses? Well, you start with the main metric being cash flow, and then you have to say, well, what is the product of the business? Do you really understand the product of the business? You know what irritates me the most is when I ask investors about a business they own or a stock they own, they go, yeah, it's a great stock. Well, what's great about it? They have no idea. What's great about a stock is the product and you understanding the product in its most simple form. Like you understand what Coca-Cola does, we understand what American Express does, and we understand what Apple does. It may be difficult to understand what NVIDIA does or Intel does. Yeah, they sell chips and so forth, but you really don't understand the business. So understanding the business and product is very important for you to stay in the game. The other part is a wide economic moat. So a product like Apple that many people own the iPhone and use their services, it's going to be very difficult for other businesses to come in there and infiltrate what they do. So that's really paramount to understanding a business. And finally, amongst other things, is superior management. Management's everything. Great management, great company, you're going to do well. Poor management, poor company, you're not going to perform well. And other areas you can look at is low debt and high returns on capital and stable earnings over the past 10 years, which is really key. So you want a company that has the stability and stable earnings that you feel comfortable with that, again, keep you in the game. So these are the key components, and the most important part by far, and Buffett talks about this all the time, is that if you're not willing to own a business for 10 plus years, don't waste your time owning it for 10 minutes. That is so true and critical to your investment performance. Well, some people may say, well, Phil, what about these growth companies where revenues are growing parabolically, right? My answer to that is that you're trying to predict the unpredictability. You're trying to predict what's unpredictable. These companies don't have 10 years of stable earnings. They have negative debt, negative cash flow, and you're trying to forecast how much product they're going to sell over a 5-year period to get you to the point where they're going to have strong cash flow. And when you do that, most of these companies are trading at stupid valuations, like I said before, like these tech companies, and investors get crushed and can lose a lot. So you don't need to invest that way to do well over long periods of time. So the micro part of investing is uncovering value, and you do that through cash flow like we just discussed. So now you have to figure out, well, how do I balance my portfolio? Because I know there are going to be periods where the economy is going to go down and markets are going to go down with the economy. So how do you protect yourself is the main question that you have. Well, first, in a perfect world, I would like you to be 100% in stocks and real estate, because over time, stocks and real estate, which has averaged 12 and 11% over long periods of time, so that means your wealth will grow much faster if you're fully in stocks and real estate. What's the problem then? The problem is during difficult periods, many investors can't hang in there. They can't handle this up and down movement. And when you look at the history of markets, there have been times where the market's been down 20%, 30%, 40%, 50%, even as great as 80% during the Great Depression. So this volatile stuff, you need to do something to manage and balance out stocks going down. So how do you do that effectively is the key. The way to do that is you have to go back and do your due diligence and understand the history of markets, right? So you have to understand that there are different economic environments, and during those different economic environments, certain asset classes perform a certain way. So for example, when inflation accelerates, commodities and gold perform well. When inflation decelerates, S&P 500 or markets, stock market, and long-term bonds perform really well. So now you might be saying to yourself, well, now I have to predict what economic environment we're into, and my answer is absolutely not. That's the exact opposite you want to do. What you want to do is you want to appropriately balance stocks, bonds, treasury bonds, gold, and commodities, and understand how these asset classes have low to negative correlation. What do I mean by negative low correlation? I mean that when stocks go down during recessions, long-term treasuries do the opposite and go up. That's always been the case during major recessions. So that's a negative correlation. You don't want assets that have the same correlation, because when one goes down, they all go down like dominoes. So that's what you do not want. So what we've done as a firm and had this studied independently is we went back 53 years and we looked at this exact allocation you see here, which is 30% stocks, 40% long-term treasuries, 15% intermediate-term treasuries, 7.5% gold, 7.5% commodities. And we use this simply for illustration purposes for you to get educated on creating a balanced portfolio. What did we recognize with this particular portfolio? Well, the first thing we recognized is during this period of 1968 to 2021, risk balance averaged 8.7 versus the S&P 500, 10.7%. So depending on your risk, you could do better than the S&P, but if you want to stay within a moderate type risk profile, this is a respectable rate of return. But most importantly, during every major downturn, 73, 74, 2000, 2002, 2008, and during COVID, for example, in 2008, S&P down 36, this was down 366. And during COVID, S&P down 20, up 1.25. 2002, S&P down 43. This is up 9.8. So what you learn from this example here is that if you properly balance different asset classes, and it could be other asset classes too, by the way, like real estate, private equity, etc. When you do that, it really does smooth your rides out, give you a respectable rate of return, but could help protect your risk on the downside. So once you balance your portfolio, you then need to know when do you rebalance your portfolio or make changes to your portfolio. So I'm going to oversimplify this for you. For example, if you take a portfolio that is 50% in stocks, 50% in bonds, and you have a situation where stocks go down because of a bad economy, now your portfolio is showing 40% in stocks, and your bonds now are 60%, because like I said before, if you own treasuries, treasuries go up, when stocks go down, typically that's what happens. And what you want to do as an investor is you want to sell your winners, bring this back down to 50%, and you'll take that money and you're going to go over here and you're going to buy stocks and bring this back up to 50%. So now what you're doing is, you know that when you look at your portfolio on an ongoing basis and you have that dislocation with the different asset classes, this is the buying and selling that happens to bring you in line to take advantage of asset classes when they're down. Because when you buy asset classes when they're down, it gives you the opportunity to make money when they eventually rebound. And this is a great example of this. So if I go to this slide here, this shows you that during recessions and after recessions, the performance of small cap and large cap stocks. After 1 month, up 2.8 to 4.8. After 6 months, 11 to 20% you make on your money. After 1 year, 17% to 32%. And then after 3 years, you're up 44% in large company stocks, and in small cap stocks, you're up 75%. So if you took that money from selling bonds and bought stocks and you rebound, it's a lot easier to get back to where you were versus not doing anything and being a deer in headlights and taking longer now to make back your money. So this is significant when it comes to building a properly balanced portfolio. So what I just showed you, looking at value and looking at balance, the end goal is, when you implement it correctly, is now to avoid what we talked about. Avoid the fear of missing out or the fear of losing money, because you have a set strategy. You know how to properly build a balanced portfolio. You've studied it going back a good amount of time, so you understand the risks. And when it comes to selection of stocks of great businesses, real estate, or if you're going to buy into private businesses, you now know how to identify value. And all of this will be transformational in terms of your investment mindset that will make a tremendous difference in your success going forward. A big question I get from investors, well, how do I find the right financial advisors? Or am I with the right financial advisor? Well, here's from my experience, and this is from my experience. I've been lecturing and I've lectured over 1,000 investors. I've met with thousands of investors. And what I found is that most financial advisors literally have no idea what they're doing. They have no idea about these concepts of cash flow and balance, but now you're armed and understanding of this. So now you can go back to your financial advisor and ask them these questions and see if they really are knowledgeable on these particular areas. That's number one. Number two, you have to find out, do they really have conflicts of interest? Are they really recommending investments that are best for you or best for them? And third, when it comes to Wall Street firms and economists and their research, it's useless. They're pontificating and guessing about what they think the future is going to be. And that's great, but that doesn't help you. What helps you is every day coming in and looking at opportunities that's of value, that you're ready to implement to your portfolio and have tremendous success over long periods of time. So to conclude, what you need to figure out is, are you really implementing this value approach and the balance approach? So what I did, I built a second opinion service for you. And with that service, we will do a full audit of your investment strategy. We will identify gaps in your strategy. And we will give you advice on how to close those gaps as soon as possible. What you decide to do with that advice is completely up to you. So what you can do now is you can click on my calendar to schedule a day and time that's best for you. We'll go through this process together and we'll see where you stand, what gaps you have, and what we need to do to make sure that you move forward. Because transforming your investment mind is a huge goal of mine. And I really hope that this was helpful in you understanding this. And you can call me anytime, email me, whatever it is I need to do to help you. So thank you for your time. It's been a great pleasure, and enjoy the rest of your day.